Today, folks, Canadian banks are crashing or they're relatively selling off on recent bank earnings. We saw Bank of Nova Scotia, BMO. We're going to analyze a little bit of those earnings just to see if the financial system is finally starting to fall apart. But we're going to hear from Tiff Macklem, our version of Jerome Powell here in Canada, the head of the Bank of Canada. We're going to take a look at an analyst that was recently on BNN this morning to give us just some clerical insight into what he thinks are the best banks to buy right now, as these dividend yields are getting so damn juicy, over 6%. My God, if this is a conversation you'd appreciate, in return, I simply ask that you hit that like button, because first and foremost, this analyst pointed out something I found very intriguing that I've been repeating like a broken clock. But take a listen.
This week, longer term, do you think Canadians can still lean on bank stocks and their dividends for their investment portfolio?
Longer term, I think banks that focus on Canadian banking, like RBC and National Bank, are going to outperform banks that chase international banking growth, like BMO, Scotia, TD, and even CIBC now with its entry into U.S. commercial banking.
So why would he say that? Well, primarily, I think because of the G7 countries, Canada has the fastest growing population, outpacing even the likes of India because of the immigration. That immigration, however, is kind of cooling off a bit because of how expensive it is here. People are actually we're having a hard time meeting the immigration, new rules. They're allowing 500,000 people a year, and we're having a hard time hitting that because it's so expensive here. Immigrants are having a hard time wanting to come here unless they're extremely wealthy. But that's why, RBC was focusing on the acquisition of HSBC, their Canadian counterpart, whereas TD was trying to acquire, I think, First Horizons in the U.S., a regional aspect of the bank, and that didn't fall through. A lot of controversial, a lot of just insanity going on with international banking. So I think that's why he thinks Canadian banking will do better, because we're just growing better. It's a little bit more concentrated, predictable, things of that nature. But let's listen to Tiff here, our own version of the Jerome Powell. Most people probably don't even know who this guy is, but he's very insightful and will tell us kind of what he thinks is going on.
The key message in this report is, yes, we've raised rates rapidly. That was needed to control inflation. And going forward, nobody should expect that interest rates are going to go back down to the very low levels that we've seen over the last decade or so.
So that's very intriguing. I know a lot of people are bullish on the market toward the latter half of this year, especially in the U.S., thinking that the inflation's dead, so they're going to be able to drop rates. But he's saying, don't anticipate rate drops. We're not going back to those lows, which is also a little bit kind of bearish on the market, right?
So we're in a transition period to a world where interest rates are going to be higher than what many people have gotten used to. And that transition, one of the important messages in the report, and as Carolyn just outlined, we've mapped out that transition for mortgages. That transition is going to take a while. And through that transition, that creates some risks. And we highlight in the report that we are more concerned about the ability of households through this transition to manage their debts. That is something we're watching very closely. In this report, we're really focused on it from a financial stability point of view, financial system point of view. We also take into account when we're setting monetary policy decisions that if households have more debt and interest rates are higher, the effect of monetary policy is bigger than it otherwise would be. There are mitigating things too. Households have more savings. So you have to sort of look at all that together. Households are proving resilient to higher interest rates. That doesn't mean that nobody's feeling any pain, nobody's feeling squeezed. No, some households are really feeling squeezed. If you had a variable rate mortgage, the increase in interest rates hit you very quickly. It is a difficult adjustment. And as we've outlined in this report, if you've got a fixed term 5-year mortgage, those are going to roll through over time, and subsequent cohorts of households are going to feel the effect of the higher interest rates. That's going to squeeze their budgets. That's going to slow down spending.
So what I find very intriguing here is that he's even stating that over a 5-year fixed rate that eventually is going to turn over, and that's really implying that something I thought about real estate investment trusts is a lot of them have really low interest rates that give it a few years here before those mortgages turn over, that they would have lowered the rates by then, at least to a more nominal level. But he's kind of just giving us those hints that, hey, if you have a long-term mortgage, get prepared, because we ain't going to be cutting these in any substantial way, and you're going to feel that pain.
That's what gets inflation back to target. but what we're seeing is that the system is coping with this reasonably well. Households are proving resilient. Canadians have a long tradition of paying back their debts. We mentioned the mortgage. Some of the policy measures put in place, I think, have been helpful. The mortgage stress test has made that more manageable. And our financial system remains strong. It's well capitalized. It's got good levels of liquidity and sound risk management. So far, things are going reasonably well. This part, though, is really about highlighting that through that transition, there are some risks, and it's important to be vigilant.
So let's just take a look at how the Canadian banks are actually faring so far into this earnings season. I'm going to be posting videos for the next couple days on these bank earnings, so consider hitting that subscribe button, because firstly, we've only really got Bank of Nova Scotia and BMO today. BMO is down 3.7%. Bank of Nova Scotia is only down about 0.81%, and actually recovering off this morning's lows. And I think that's just because people are seeing some of the resiliency here, as these yields are insane. 6.25% right now on BNS and 5.06% on Bank of Montreal. This is going to be a glimpse of a period where I don't believe this is going to last. Now, from performance standpoint, Bank of Nova Scotia is not the most resilient from a capital gain perspective, right? Compared to Royal Bank, National Bank, I think those those banks have paired much better from a gain perspective. But if you're looking for income, these things have never cut their dividends. They survived all the recessions much more resiliently than the U.S. banks have. And even during this period, I think one of the biggest things hindering them is, again, the fear of what might come. And that fear leads to loan loss provisions, right? And take a look at this, because just for the last 6 months alone, Bank of Nova Scotia has put away $1.3 billion in loan loss provisions, which is just staggering. And net interest income over the last 6 months has actually grown by a couple $100 million. And as I've stated before, I think we're going to head into a slow period where these banks are going to get hit. We're going to see a slowdown in revenue. We're likely going to see a slowdown across the board here, but what's going to happen is that's going to go away after a while, and these suppressed stock prices are also going to go away after a while, and we'll go back into a new, normalized, probably more bullish of a market where you're not going to see these super high 6 to 7% yields on these banks. I'm saying that, again, it's a buying opportunity, but it's one that's going to persist probably, I'm going to say, for the next couple years, at least another year, until we kind of get out of this tumultuous market, and they'll stop putting these loan loss provisions aside, which will inevitably come back to the net income, because net income right now from the diluted EPS standpoint is abysmal. Look at this. For the last 6 months, $3.07 versus this time last year where it was $4.32 when they were putting loan loss provisions aside here, guys. You take a look at this time last year when it was $441 million against that $1.3 billion now, which is astounding, right? Now, what I find most intriguing is that analyst was very bearish on the international banking that BNS had. So for the Canadian banking side of it, revenue was up 8%, but net income down 10%. Again, a lot of this is baking in from loan loss provisions. But if we actually take a look at I want to just take a look at international banking specifically here. International banking, the revenue was up 8%, right? Net income was in line. Pre-tax provision profit is up 6%. Expenses were up pretty dramatically here. They were up 9%, but apparently down 1% quarter over quarter. I'm kind of intrigued to see how this pans out, because I know Bank of Nova Scotia specifically isn't as paired to the U.S. as something like TD's trying to be, or Canadian Imperial Bank might be. I think when it comes to Scotiabank, they're more into Latin America, all in all. So again, I am not an expert on banking here. I just know that, if history rhymes in any way or fashion, that these banks have just boded very well as buying opportunities in any major dip. You look at BMO here, which is trading down 3.7, probably hit of the hardest of the banks, but again, one of the best performers coming out of the, the pandemic era. So, this bank's kind of just looks like it's heading into correction mode with a 5% yield. Let's just take a look here real quick as well. Again, on the provision for credit loss side, just to really quickly highlight, this is sitting at over $1 billion for this quarter for Q2 compared to Q2 of last year when it was only $50 million. Just look at this year-to-date total, $1.2 billion compared to year-to-date 2022 where it was $49 million. That's where all this money's going to, right? So it's just making the net income look quite a bit abysmal here. A diluted EPS year-to-date is $1.62. Year-to-date 2022 was $11.57. Again, this stuff looks terrifying, right? But that's, again, you don't want to look at EPS on banks. You really want to pay attention to the revenues, which for BMO is not the best here. If we take a look at total revenue, guys, it's sitting at about $8.4 billion versus this time last year was $9.3 billion. So we're starting to see some flatlining. That's what we're seeing with Bank of Nova Scotia. Mostly flatlining, a little bit of declining. but nothing to cause like massive scare. I mean, that's why we've got our own Federal Reserve here, our version of the Fed, saying that, you know, the Canadian Treasury just saying, hey, like they're pretty resilient in this market environment. So again, I'm not getting too ups in arms here. I'm just looking at this as a continued place to cost average using my favorite stock, ETF VDY, that monthly paying juicy income. I'm going to talk about my portfolio updates. I'm actually selling a lot of stocks right now. I'm going to break down why I'm doing that. So consider subscribing for those updates as well. But stay cool, stay awesome. I'll catch you in the next one, folks.